Welcome to the deep dive. Today, our mission is to uh, really cut through the noise in one of the most dynamic sectors out there, software application. We ran a pretty focused stock screener. The idea was simple. Just pull stocks trading over $10 with daily volume above 1,000 shares.
Right, and what's so fascinating is that those simple parameters gave us this perfect cross-section of the entire market.
Not just a list of similar tech companies.
Not at all. We got three companies that could not be more different. First, Salesforce, ticker CRM, which is, the mega cap champion.
Giant.
Then we have Lyft, LYFT, that's the mid-cap challenger, kind of fighting its way through a turnaround.
Yeah, and the third one is where it gets really wild.
Treasure Global, TGL, an extremely volatile microcap. I mean, this one is pure speculation.
So our mission today is to dissect each one. We'll look at the fundamentals, the technicals, what the news is saying.
And the valuation. And then for each one, we'll run our paper money challenge. We'll take a hypothetical $5,000 investment and estimate the profit or loss based on some recent performance.
Okay, before we jump in, just a quick but very crucial reminder for you. This discussion is purely for educational and informational purposes. We're just analyzing historical data here.
That's right.
This is not and should never be taken as financial or investment advice. All right, let's start with the big one. The enterprise anchor Salesforce, ticker CRM.
Yeah, this is the definition of a powerhouse. We're talking about a market cap of, $248 billion?
A true giant.
Yeah.
So when you look at the numbers, what's the first thing that jumps out?
For me, it's the valuation, because it tells a story about investor confidence. The current PE ratio is about 34.77, which is healthy.
Right.
But the forward PE, the one that looks ahead, it drops all the way to 19.97.
Wow, that's a big drop. So what does that actually signal?
It signals a ton of confidence. That steep of a discount suggests that investors really believe management's guidance. They're pricing in future cost savings and efficiency gains, probably from AI right now.
So the market is buying into the future story, not just the present.
Exactly. And that belief is backed up by some really stellar operational health. Just look at the margins.
Okay, I'm seeing a gross margin of 70.07%. That's huge.
It's immense. That means they have incredible pricing power on their core product. And then after all the costs, the operating margin is still over 22%, and the profit margin is almost 18%.
So they're incredibly effective at turning revenue into actual profit.
That's the engine of their resilience. It's why big institutions own over 82% of the company. They're buying that stability.
And the big news catalyst recently was that Q3 earnings beat, right? It sent the stock up over 5% in a single day.
It did, and the narrative driving it wasn't just about cloud computing anymore. It was explicitly about AI momentum.
They really hammered that point home.
Oh, yeah. They raised their forecast. They talked about the Agentforce Life Sciences platform. It was all AI-powered adoption. Wall Street is rewarding companies that can show a clear path to actually monetizing AI.
Which leads to a strong analyst consensus. I'm seeing a recommendation of 1.56, basically a strong buy, with a target price up around $324.
It all fits together.
So let's look at the technicals. The stock closed recently at $260.57. The RSI is sitting at 66.36.
And that's a key number. It means there's strong buying momentum, even after that earnings spike, but it's not in that overbought territory yet.
So there's still room to run, potentially.
Potentially, yeah. And it's also sitting just a tiny bit above its long-term moving average, the SMA 200. The real opportunity here, technically speaking, is recovery.
What do you mean by that?
Well, even with this recent surge, the stock is still almost 30% off its 52-week high. For a stable company like this, with a pretty manageable beta of 1.28, that's a significant gap.
Got it. Okay, let's do the paper money challenge for CRM. We have our $5,000 paper budget at $260.57 a share. That lets us buy 19 shares.
For a total investment of $4,950.83.
Yep. And to measure this one, we'll use its quarterly performance, which was a steady plus 3.29%.
All right, so that 3.29% return on the invested capital, that works out to an estimated paper profit of $162.88.
A respectable return. It really reflects the low volatility, steady Eddie nature of a market leader like Salesforce.
Exactly. It's the anchor for a reason.
All right, now let's completely shift gears. We're going from the reliable anchor to the much more volatile competitor, Lyft, ticker LYFT.
Yeah, this is a totally different beast, a $9 billion mid-cap, and it's just locked in this constant battle with its much bigger rival.
And the valuation metrics here look messy, contradictory even.
They are. It's a classic turnaround story. You see a high PE of over 63 and a really high price to book of 16. That suggests it's, pricey based on its current value and
So
earnings.
there's always a but.
There is. And here's the hook for traders. The price to sales ratio is actually quite low at 1.46.
So what's that telling us?
It's telling us that the market is valuing Lyft's revenue, the actual money coming in from rides, pretty cheaply. So investors are buying that cheap revenue and basically betting that management can figure out how to make it profitable down the line.
But that path to profitability, it's got some warning signs on it. The quick ratio and the current ratio are both at 0.72.
Right. And for anyone listening, a number below 1.0 is a red flag. It signals immediate liquidity pressure.
So practically speaking, what does that mean?
It means that if all their short-term debts came due tomorrow, they technically couldn't cover them with their liquid assets. You couple that with a high debt-to-equity of 2.30, and you realize this turnaround story has some serious financial risk.
And yet, the stock has had incredible momentum lately. The earnings from November showed EPS quarter-over-quarter surging, 470%?
Yeah, an astonishing number. And that's what's driving the positive narrative right now. You're seeing headlines about gross booking growth and customer-friendly deals.
So that sequential growth from one quarter to the next is what everyone's focused on.
It's the critical factor. It suggests their cost-cutting and pricing changes are finally working. But you can't ignore the context.
You mean Uber?
Always Uber. Every time Uber makes a move, like launching robotaxis, it puts immediate pressure on Lyft's valuation.
And the technicals confirm this is a high-risk, high-reward bet. The beta is 1.93.
Almost twice as volatile as the market. It's a wild ride. And that volatility has led to huge recent gains. The year-to-date return is over 78%, a massive recovery from its lows.
And there's another dynamic here, isn't there? The short interest.
Oh, absolutely. The short float is high, over 17%. That's a lot of people betting against the stock.
Which can be fuel for the fire.
It's pure fuel. If the good news keeps coming and those short sellers get nervous and start buying to cover their positions, you could see a massive short squeeze, an explosive upward move.
Okay, let's run the numbers. The paper money challenge for Lyft. At $22.97 a share, our $5,000 budget gets us 217 shares.
For a total investment of $4,984.49.
And since this has been such a huge turnaround play, let's use the half-year performance. A remarkable gain of 47.91%.
And that 47.91% applied to our paper investment generates an estimated profit of $2,388.04.
Wow.
A dramatic result. But it perfectly illustrates the kind of high-stakes reward you can get when a volatile stock actually pulls off a recovery.
Okay, we've seen the anchor and the turnaround. Now we're moving to the absolute fringe of the market. Treasure Global. TGL.
Yeah, this is not even in the same league. It's a tiny, tiny micro cap. The market cap is just $21.5 million. This is where the risk spectrum just goes off the chart.
The financials look, alarming is maybe too soft a word.
They're designed for pure speculation. The EPS for the last 12 months is negative 110, and the profit margin is, get this, negative 1,065%.
Minus 1,000%. How is that even possible?
To put that in context for you, it means for every dollar of revenue they bring in, they are spending multiples of that just to stay in business. It's a cash burn of epic proportions.
So this is a pure binary bet.
Completely. It either hits those explosive growth projections everyone talks about and survives, or it runs out of money and goes to zero. There's no middle ground here.
And the ownership structure reflects that. Insider ownership is over 41%.
Which means the founders and the leadership team have huge stakes. They're all in. But look at the flip side. Institutional ownership is basically non-existent, 1%.
The big, steady money is staying far, far away.
They won't touch it. And the corporate actions are just as extreme. They just announced a 1-for-20 reverse stock split.
Which they do to keep the share price up to stay on the Nasdaq, right?
Exactly. But for a microcap, it's often a major sign of distress. It can create a lot of negative psychology for investors who suddenly own far fewer, more expensive shares.
But the story they're selling is all about that. High risk, high reward. I've seen reports projecting over 500% revenue growth by 2026.
And it's all hinged on these emerging tech areas, fintech, AI, digital assets like their OXI wallet.
Yeah.
It's a bet on a revolutionary future.
Now, technically, this thing is it's pure volatility. We saw a single-day change of over 276%.
Jaw-dropping. And it was fueled by volume that was 115 times the average. That relative volume is the only technical indicator that matters here.
The official beta is listed as 0.01, which seems insane.
It's nonsensical. The standard models just break. They can't capture these kinds of extreme illiquid swings. You have to ignore the beta and just look at the volume and the daily percentage change.
And even after that massive one-day spike, the stock is still 96% off its 52-week high of $780.
That range right there from $5 to $780 tells you everything you need to know about the risk you're taking on.
All right, let's run this final paper money challenge. At $25.44 a share, our $5,000 buys 196 shares of TGL. Total investment, $4,986.24.
And to capture the explosive nature of this, we have to use a very short time frame.
Let's use the one-week performance, which saw a spike of 92.15%.
That phenomenal weekly surge gives us an estimated paper profit of $4,594.13.
Almost double the money in a week, on paper.
It's an incredible result, and it highlights the fundamental difference. With CRM, you're buying reliable cash flow. With TGL, you are purely gambling on a corporate action and a promise of a revolutionary future.
So that deep dive really laid bare the massive spread you can find within just one sector, software application.
It's a whole universe.
You've got the giant CRM offering stability and predictable returns. Then LYFT, the high debt turnaround, trying to convert revenue into profit.
And finally, TGL, the microcap, where the entire valuation is based on a speculative dream of future growth.
And if you synthesize their financial DNA, it just confirms the risk profile of each one.
It really does. CRM's 70% gross margin and 1.28 beta just screams stability.
Whereas LYFT's liquidity issues and that 1.93 beta signal high operational risk, even with the growth.
And TGL's negative 1,000% margin confirms it. You're not buying a business, you're buying a lottery ticket that's hinged on a reverse split and a fintech revolution.
I think this really reinforces why you use a screener. It's not just to find names, but to understand the completely different financial worlds and risk tolerances that exist even within the same industry.
Exactly. You have to know what you're buying. Are you buying a PE of 34, or are you chasing a story with a negative PE? You have to look at liquidity, at real volatility indicators, not just a misleading beta.
You have to match the opportunity to your own risk tolerance.
Which brings us to a final interesting question for you to think about. We saw that Salesforce's success was tied to leveraging its existing huge infrastructure with AI.
Right.
While TGL's entire value proposition rests on future tech, like digital assets that haven't delivered any profit yet. So is the market creating this sort of dual system.
What do you mean by a dual system?
Are the established players, the CRMs of the world, now capturing both stability and the AI momentum? And if they are, does that relegate these high-risk microcaps, the ones selling pure future tech dreams, permanently to the fringe, even with their potential for these huge short-term pops?
So what price are you willing to pay for certainty versus pure speculation in today's tech world?
Exactly. Something to think about.